And good morning, options traders. Welcome, everyone. I thought it would be helpful to talk a little bit about a strategy called a systematic writing strategy. It's one of the more interesting strategies out there because it shows the versatility of options. And for many of the new traders in the group, they usually think, well, I understand how to buy a call or a put or how to sell it, but that's pretty limited. And that's not really true. The real power of options comes from combining strategies and allowing you to accomplish your goals, but by hedging risks. So what is the systematic writing strategy? Well, it is a three-step process, at least at a minimum. And what you're going to do is to sell options to buy and sell shares. So it's just a way of using these option premiums to acquire shares that you like and to turn around and sell them. Now, the entire process takes a minimum of 4 option premiums, and you'll see why in a moment, but that's another big power, is you're going to collect at least 4 option premiums to buy and sell shares that you are going to buy and sell anyway. Now, little caveat here, word of warning, it does use naked puts. And you know that for the most part, I tell traders to not do these. I've talked about the problems with normalized Vega, which I do have a video in here on these issues. So if you're not real sure about some of the potential dangers of naked puts, don't do this strategy, at least until you become more advanced. But I still think it's an important strategy to show the versatility of options. So how can you tell if this might be a strategy for you? Well, if you're going to sell these naked puts, you absolutely must be 100% sure that you will take the assignment and buy the shares. It's got to be part of the strategy. You can't be selling these naked puts thinking, well, I'm just going to grab this free money, and then when you get assigned, panic and bail. It's got to be part of the strategy. All right, so that's a very important key. So keeping that in mind, what is the three-step process? What is the system of writing? Well, step number 1, you're going to determine how many shares you're willing to buy. And you will sell puts on half the amount. So let's say that you're willing to buy 400 shares of Apple. You will start by selling 2 puts, half the amount. Now, of course, there's a lot of versatility here. You could sell in the monies, at the monies, or out of the monies. If you sell them in the money, you're going to have a much higher probability of being assigned and yet still collect some premium. At the monies are going to give you the most premiums, but they will also give you a higher chance of being assigned. Out of the monies give you a smaller chance of being assigned, and they will also give you smaller premiums, but they will probably give you more chances to repeat this step. So that's the whole point here, is you are going to continue selling these 2 puts, and you will repeat step 1 until you are assigned. So again, this is the importance of it. You absolutely must be ready to take the assignment. That's part of the deal. So how long could you stay in step 1? Who knows? Got to do it at least once, but you could be here for 2 or 3, 5, 10 times. You're going to just continue selling these puts until you are long the 200 shares. And when you get assigned, then you move to step 2. So let's say that we do this and we've finally taken the assignment. We've moved to step 2. We're now long 200 shares, right? We sold 2 puts. We keep selling them until we are assigned. We've got long 200 shares in the account. But we're willing to buy 400. So there's really no harm at this point. We haven't really exceeded our risk tolerances at all. And what we're going to do in step number 2 is to sell what's called a covered straddle, or it could be a strangle if we split the strikes. But the idea is the same. So let's say that you sell 2 puts and 2 calls. So again, let's say that Apple is currently trading right now at 120. You might say, all right, I'm going to sell the 115 puts and I'm going to sell the 125 calls. So here we've got the call and put 5 points out of the money, so this would be a strangle. If we decided to sell the 120 strikes for the calls and puts, then it would be a straddle. But the idea is always the same. We're going to try to round out our 400 shares by selling this covered straddle or this covered strangle. So notice at this point we have taken a minimum of 3 option premiums, right? We took 1 premium in step 1, and now we're going to capture 2 calls and 2 puts. And what's going to happen here? Well, you're going to continue step number 2 until you get assigned. So again, this is part of the plan. We absolutely want to take the assignment. But notice there's two different ways we could get assigned. Right here we could get assigned on the 2 puts and have to buy 200 shares. But we could also get assigned on these 2 calls and have to sell 200 shares. So what is that going to do for us? Well, once you are assigned in step 2, one of 2 things have to happen. If you're assigned on the puts, you're now going to end up being long 400 shares, in which case you will go to step 3. So remember, in step 2 you were long 200 shares, we just got assigned on 2 puts, we're now long 400 shares. And it's only at this point that we would go to step 3. However, as I mentioned previously, you could get assigned on the calls. And if you are assigned on the calls, you've now lost your shares. That was basically a covered call. And you've got 0 shares. Now you go back to step 1 and you continue selling puts until you pick up those 200 shares again. Now you can see why it's called a systematic writing strategy. It's like a computer program. It's just a series of if-then statements telling you when to buy and sell. Another beautiful thing about this strategy is that it does tend to keep the emotions out of it. The system is actually telling you what to do. So let's assume that we stay in step 2 for a while. We continue selling these covered straddles or strangles. We're collecting a lot of premiums, and we're going to do this until we get assigned. And now we're long 400 shares. We haven't exceeded our risk tolerances. We were willing to buy 400 shares, and we've got 400 shares, but we've also got a lot of cash in our pocket. But now we're ready to move to step 3. So in step 3, remember, we're long 400 shares. What do we do now? You're going to sell 4 calls. So this is just a straight up covered call strategy. And you will continue selling calls until you get assigned. Just keep doing it week after week or month after month until those shares go out of your account. So again, to do this, to complete one full cycle, you collected at least 4 option premiums to buy and sell the shares. And that's again because we don't know how long we're going to be in step 1 or step 2 or step 3. We could be there for quite a while. But the bare minimum is that you got assigned in each step right off the bat, and you had to collect at least 4 premiums. So we stay here in step 3, writing these covered calls until we get assigned. And what do we do now? You guessed it. You go back to step 1 and start writing the puts again. Well, let's go take a look at some actual Apple quotes and see how the strategy might play out. So today is September 15th, 2020, and Apple opened at about 117. And so for the example, I'm going to look at the 10-day options. Step number 1, perhaps we sell 2 of the 115 puts. So they're just slightly out of the money, currently trading for about 250. And we keep doing this every 10 days until we get assigned. But if we get assigned right off the bat in this first round, we will then own 200 shares at a cost basis of $114.50. That's just the 117 stock price minus the 250 premium that we brought in. What do we do now? You move to step 2. And now maybe we sell, let's say, 2 of the 110 puts and 2 of the 120 calls. I'm still assuming that the stock is around 117. But remember, the strategy is very flexible. Maybe the stock has moved down to 115. Well, maybe I sell the 110 puts and the 115 calls. We can always make decisions based on current prices. So when I collect these premiums, they are currently trading for about $250 on the puts and about $280 on the calls. So that would be another $5.30 in our pocket. So as soon as I sell those premiums, I now have a cost basis that is reduced from $114.50 to $109.20. What do I do now? I stay in step 2, selling these covered straddles or strangles until I get assigned. So remember, there's one of 2 things that will happen in step 2. If you get assigned on the calls, you're going to lose the shares, in which case you return to step 1 and start writing those puts again, trying to acquire those 200 shares. But if you get assigned on the puts, then we're going to be long our 400 shares. And so what do we do now? We move to step 3. And maybe I will sell 4 of the 120 calls, again currently trading for $280, and that's going to immediately reduce my cost basis from $109.20 to $106.40, with the stock up at $117. And I'm going to stay in step 3, writing these calls every 10 days until those shares get called away. And at that time, I return to step number 1 and start writing puts again. So I hope this systematic writing strategy helps you to see the power of options, whether you use the strategy or not. It shows that even if all you know is buying and selling of calls and puts, it doesn't mean that you're limited to buying calls because you think the stock is going up or buying puts because you think it's going down. Instead, think of ways that you can harness the power of these basic elements, these calls and puts, into powerful strategies that allow you to meet your goals and reduce your risk. And the systematic writing strategy is a perfect example. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.